Dory, even though we've had kind of a rough week overall in the markets, you say that we should just keep swimming with this post-election market rally. Why?
Well, the market's pouting, right? It's pouting because Jay Powell came out and said, hey, PPI is up a little bit and the CPI is a little bit sticky. We need to be cautious about raising rates. So I still think he has a cut bias if he can do it. But the market has tapered its expectations, and I think it should do so on cut rate. But having said that, this market still has plenty of room to run, and it doesn't need rate cuts to do so. It's earnings, and earnings are there. They've hung in there for this third quarter, and the growth expectations and performance of earnings moving forward are actually quite good. And I expect to see some good rotation into small caps, and banks are a good place to play.
Okay, about those banks, if I can put on my skeptical hat, the KRE is over 65 right now, nearly doubled from the post-Silicon Valley Bank lows, maybe even getting into that, 70s territory, which would be all-time highs. It would be great if you got in like a year or two ago, but why now?
Well, some of us were, but I don't think it's time to sell yet. I think it's still good. People have been afraid of small caps, and I think there's good reason for that. A lot of small caps aren't profitable. They're too levered, and the rally will be sustained on good, profitable companies, not on hopes and dreams. Well, small cap banks are a good place to play. They've managed their asset liability risk, which took down, Silicon Valley and some of these others as a big part of the equation. They're growing. A lot of these banks, several of them that I like, they hold big capital positions, higher capital ratios than the money center banks, and they're growing tangible book value per share. Earnings are expanding, and now we have a friendly regulatory environment where we can actually get some M&A activity going, and I expect valuations to increase with that.
Dory, it's Kelly here. Third Coast Bank is one of your picks. It's up 72% this year. What's driving that, and where else do you think is a good opportunity?
Yeah, that was a sleepy find out there for a lot of people. Full disclosure, we're a big investor in that, but it's a great bank. It's in all the major markets in Texas. We all know what the attractiveness of Texas. They have a nice, stable margin. They're running a very high capital ratio. They have the highest growth of tangible book value per share of any public bank in the state of Texas. And that's what matters at the end of the day. You grow your tangible book value per share, and it works. It's still a buy because it's still a very low price stock on a price to tangible book value basis, and only 12 times forward earnings. So there's still room to run for that bank.
All right. And then, I know you're kind of looking there more than the bigger banks, but because you know so much about valuations, when you look at the run and Goldman, some of the other investment banks and so forth, are they now looking fully valued, or do you think even among the top banks and maybe some of the money center banks, they could be good holdings?
Yeah, I'm a pause on the big money center banks. I think there's more room to run on some of those small caps, simpler models, easier balance sheets to manage. Third Coast, for example, has a positive gain in its AOCI versus losses in its securities portfolio. It's just much more attractive. We also have Trustmark and EFSC up there as well, and very similar stories, very dominant banks in their markets.
All right. Dory, thanks for joining us. Appreciate it. Good to see you again.